Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Today is Friday, April 21st, 2023, and it's a little bit of a slow news day, but I picked out a few things here to talk about. I just this morning sent out a kind of breaking news update to my premium subscribers over on bitcoinandmarkets.com. It's all about the Treasury bill market, what we're seeing going on in the 4-week Treasury. And so we're going to cover that. We did cover that a little bit yesterday on FedWatch, but I've done some more digging, some more thinking. And so we're going to see what we can learn about that situation and what it means for the broader market. Overall, what we see in the Bitcoin market today is a little bit of a price dip. So we'll go over that chart. We'll go over a few other charts and then talk about that main topic. So if you guys want to join the live streams, I'm live streaming on YouTube, Twitter, Twitch, and Telegram. Telegram typically is the best audio, except when I play video clips or whatever to the live stream audience, then the Telegram folks can't hear that because it doesn't share my system audio. But these live streams are put up on YouTube and stuff forever, so you can always go back and watch the full episodes. But I do also edit them down and put out, shorter, more concise versions in the podcast app. So check all your podcast apps to find Bitcoin and Markets there. Thank you for joining me. Let's get into the show. So what you're seeing here is the website with this Market Pro. We're going to go over some of my reasonings in there, what I've found. Also, FedWatch came out on podcast version. So anyway, just check out bitcoinandmarkets.com. You can sign up to support me if you'd like to. And I appreciate everybody that supports the show. You are what makes my content possible. So let's get into some more of this. Let's get into the charts. So this needs some explaining, and I'll share this now with Telegram. And at the end of this, I'm going to open up the mic to guys over there on Telegram. If you have any theories, you have any other information from other sources out there. I know Jeff Schneider has been talking about this a little bit, but Jeff Schneider's content is always very cryptic and mystical. He doesn't ever go the full way to explaining exactly what's happening. And these markets aren't cut and dry, but I think he can do a better job of explaining not only what's going on, but what are the implications of that. And so that's what I tried to do in today's premium letter that I sent out, all about this 4-week thing. But you can see it's fallen way past support just in the last few days. It's just totally collapsed under 3.5% when the Fed funds range is up here at 4.75 to 5%. So what's going on here? Why is this happening? Well, we know for starters that it is not due to the Federal Reserve. Okay, we just have to put this to bed right off the bat that the Fed is not in control here. This chart alone, if you weren't convinced by the 10-year being at 3.5 for 6 months and not responding to rate hikes, just look at this 4-week. Okay, the Fed is not in control. Let's put that, once we realize that, things start making a little bit more sense. Now we have to decide what exactly is happening. So I'm going to go over to my write-up here. I'm not going to share the back end here today with you guys on the live stream, but I'm just using this as my notes. So we can say it's not the Fed. We can also say for supply and demand reasons, right, that as supply, like what can explain a crash in yields? That is a spike in price. And the way that the bill market works is you pay under par. So you pay a price that's under par, and then at the maturity, you get the par value. And then they impute the interest rate there. And so we know that either supply, because this means price is spiking. So supply either has to be being cut or demand is spiking. So I went into the most recent 4-week Treasury auctions. There's about one every other week or every 10 days or so. And there was one on the 18th of April. So that would be, which candle is that? Let me get an arrow out. That's this red candle was the 18th. And then there was another one, I believe it was on the 11th. So that would be this red candle. And I'll share this with Telegram. So it's not really a supply issue. The total amount of 4-week treasuries that were auctioned, that did decrease. Okay, that has been decreasing. February, it was very high, about 71 billion every 2 weeks. Now it has dropped to about 47 billion. But there's always about 3 times as many bids as there are treasuries to buy. And so it was oversubscribed by 3 times. So out of the 47 billion that was auctioned on the 18th, there was $147 billion offered. The low bid was 0. And Jeff Schneider has talked about this in the recent past, but the low bid was 0. This occurred back in March twice, March 11th and March 23rd. Those were 17th, maybe it was March 17th and March 23rd. Those were the 2 auctions that happened around SVB and Signature and the First Republic that was starting to have problems. So those are more understandable why you would have a low bid, because people were fleeing, they were panicking to safety. But we don't see any bank failures right now. There's nothing out there that's in the headlines that there's a bank failure. I mean, they could be failing and we just don't know it. Maybe there's some sort of gag order on the financial press saying, do not report that this major bank is having issues. That could be a possibility. But overall, what for this section, so I say it's not the Fed, and I say supply and demand. It's not the supply that's being drastically cut abnormally. It's an abnormal spike in demand. So I'm just slowly whittling my way through this because I don't know what's going on. I'm trying to figure this out, and I'm walking through this and bringing my subscribers with me on this journey. So, okay, next is tightening credit conditions. Some people, like I've reported here recently, some people might say, oh, it's due to like the SLOOS data we talked about, some other banking surveys out there showing tightening credit conditions. And we know during tightening credit conditions, rates fall due to the interest rate fallacy. We know that. But this isn't indicative of gradually tightening credit conditions. This is indicative of a panic. Something is out there that has made this move over 1.5 percentage points in 2 weeks' time. It's utterly insane what's going on here. So I don't think it's due to this gradual tightening of credit conditions, which we are seeing out there. But I think we can kind of do away with that. The next thing I looked at was the deposits. And I talked about this on FedWatch. Let me go to this chart. This is a chart of deposits in all commercial banks. And you can see it's negative for pretty much the first time ever. I mean, it was a little bit negative back here in 93 and 94, just barely ticked negative. This is the growth rate of commercial deposits. And it's very, very negative. Now, what does this mean? I say that in this letter that I sent out to subscribers, the March auction results were affected by the banking crisis in that month. That crisis was a depository one caused by people withdrawing their deposits. Why do deposits matter for banks? Commercial banks earn some income from deposits, like fees, but not enough to cause this kind of market move. I don't think this is a balance sheet issue. And I had to break that apart here because deposits are like reserves, don't really matter for the banks. What matters for the banks is liquidity. Okay. If I have a balance sheet issue, I can still make loans. Because there's no reserve requirement. Okay, so they can effectively make loans. They can effectively still make income off those loans, and they're still solvent. But the problem is not on the balance sheet. The problem is at the repo window. The problem is the liquidity. So the deposits matter because deposits wouldn't leave a healthy bank. So it's the imputed stigma. What is the interpretation of deposits leaving a bank? It's in big trouble. Okay. So it's a stigma, even if they're not in big trouble. And then that affects the ability for these banks to get liquidity at all these different windows that they're, the repo windows and in the repo market in general, the tri-party repo and all that stuff. I don't understand all the plumbing, but they need access on a daily basis to revolving credit. And if they don't get it because deposits are leaving, making them look like a bad risk, then they can instantly lose access to any liquidity and go under. That is the problem here. It's not a balance sheet issue. It's a plumbing issue. All right. But this also is very interestingly looks a lot like this chart. And this is the M2. I haven't been sharing these with Telegram. So what I'm going to do is I'm going to dump in here these two charts. Well, you guys probably saw the other one, but that first one I put in there is M2. And then the second one is the deposits, and it looks very close to the same. So what do I say about M2 here? First off, M2 does not necessarily measure money supply. It measures money in certain forms. Okay. Like it doesn't really help us to know how many paper dollars there are. If we want to know the overall money supply, it doesn't help us to know how many $100 bills there are, because money is esoteric. It can be rehypothecated. It can be lent out, used as collateral, et cetera, et cetera. So there's all sorts of different things that go into the money supply. So M2 doesn't measure money supply, but what it does measure is a certain type of money. Okay. So I'm using it in this write up to subscribers that M2 simulates bank liquidity, and very similarly to deposits, but this is almost like a direct measure of bank liquidity. And I could be wrong on this. Okay. I'm just trying to connect these dots here. So we have bank deposits kind of causing M2 to go down in a way, because that's the liquidity in the banks. They represent stigma and liquidity respectively. And then I ran across this other chart, and let me show you this one from this morning. If I can find it here, I'll share this tab, copy this into Telegram. And so what this one shows us is, well, the blue line is quote unquote inflation. It's CPI 16 months advanced. Okay. So they pulled it forward 16 months. Is that right? Yeah. But what I'm concerned about on this chart is the M2. So the black line is M2, and what jumped out at me, I immediately went to the Great Financial Crisis. I wanted to know what happened in the Great Financial Crisis because I kind of understand what happened in COVID. It's fresh in our minds, okay? But a lot of the stuff that happened during the Great Financial Crisis, even though I lived through it and I was paying attention, it's not fresh, right, in the mind. So I went to the Great Financial Crisis, and what do we see here? We see a dip in M2. It didn't go negative, but it was a big dip. And what did that lead to? It led to the European debt crisis, not necessarily to a long-term U.S. crisis. Okay, the U.S. crisis was not contained, but it was pretty much handled by, like, say, 2010. We were in recovery. Okay, Europe wasn't like that. They struggled for several more years, with Greece and Italy and Spain, the pigs, and it went on for a long time. So if we're seeing this M2, US M2, which is bank liquidity, dipping, my expectation is that Europe is going to be the epicenter of this. So that gets us through that part. And what else do I say here? So I go through and I make some predictions because I think it's important that I'm using the baseline of my general thesis of understanding a deflationary credit money that we have today, specific geopolitical framework. And now on top of that, this 4-week Treasury bill crash. Now I'm trying to connect all these dots and make predictions. And so that's, I think, the best way to test your understanding is to make specific predictions. Not say, like Peter Schiff, I mentioned right before we hit live to my guys on Telegram, I was like, oh, Peter Schiff is out there saying gold is on the launch pad again. I mean, that's not a specific prediction. And you must make specific predictions in order to test your hypothesis. Okay. So anyway, I go through here and I make some specific predictions. I'll pull out a couple of these actually. So what do I say? That this is due to it being an interbank money flow issue, a plumbing issue. I expect a high profile bank failure relatively soon. I think that's very likely to happen. But the main contagion will be felt in Europe. I think it will roll over to international interbank money flows. And since the US has the FDIC, they have the Federal Reserve, they have the Treasury Department, and they can swoop in like they did with SVB and with Signature and make people whole, just a wholesale takeover of banks and stuff. Even very large banks like Signature was the third largest bank failure in American history, and they just swooped in on the day and took it over. Okay, so they have even practice now on this, just immediate firefighting by taking over the bank. And so I think that this is a plumbing issue that won't be allowed to spill out into the broader economy because they would rather nationalize pretty much the entire banking system than let it spill out like they did last time. So, and I think they will err on the side of being too aggressive by taking over banks. The only issue would be if it was one of these systemically important banks, like if it was Bank of America, JP Morgan, then there would be major issues. But as long as it's like smaller banks, I think they can still do this. I also say that we should see the T-bills starting to get affected down the line. So the 3-month, the 1 year should also start to fall. What else do I say? So in Europe, the Italian government bonds, they have an outsized importance in the repo market over there. The German boons aren't used as much because, as Jeff Schneider tells us, there's just not very many of them because Germany is more fiscally responsible. And so there's more Italian government bonds, and it's since everything is protected by the ECB and all of that, that the Italian government bonds play an outsized role in their repo markets and their financial markets over there. So they're also very highly indebted. And so I think Italy, if I'm correct, okay, these are my predictions. If I'm correct, that the natural candidate will be Italy to see some major problems similar to the European debt crisis, if that's what we're starting to see now. Now, I have been predicting this for a couple of years. I said that, after the great financial crisis, we had the European debt crisis. So we had the COVID and the quote unquote non-textbook recession in 2022 for the US. What was coming after that? I believed it was going to be a European debt crisis. And again, this is kind of an extension of that. I say the Fed will pause, and I go into a little bit more detail on that. I do not think they will restart QE. But overall, if the Fed pauses, they contain this by taking over banks like they did with Silicon Valley and Signature. And they pause. And Europe experiences more pressure than the US market because they don't have this umbrella of the Federal Reserve and the FDIC and all that. Then we could see capital flight into the US. And I think this is a perfect storm, actually, for a bullish move in the stock market and in Bitcoin. But anyway, we'll see about that. So that's my kind of breakdown. I know this is a weird episode, but it is Friday and we're just going with it. What else do we have to talk about? Let's go back to the chart and let's pull up some other ones here. So we have Bitcoin is not looking so hot. I have to take these off. It's not looking so hot, but we do have a chance to bounce on some levels here. The 50-day is next, and that's coming up at 26,800. The 200-week, 25,000. So there's a few levels here that we can bounce on. And remember, in a bull market, support tends to hold, and you tend to bounce on levels like the 50-day moving average and stuff like that. So I think if we are in a bull market, which that's what I suspect, we should bounce off the 50-day. And if it doesn't, and it goes down to say 25,000, that's a sign that we're not in a bull market yet. And that could be not scary, but just depressing because we need to get back to the halving's coming. We need to be on schedule. And probably, when was this? This was early March. It might have been on some of my content. Maybe I was being defeatist about this, but we want Bitcoin to change the world. And we want, especially for my show, in a bear market, you don't get very many listeners. You don't get very many eyes and things like that. So just all of this whole project of Bitcoin and what we want to see change in the world, and even my own show's success, it's really dependent on this. And it's just depressing as hell if this does break down and we have another, say, 6 months. But look, that's the way the market goes sometimes. And yeah, I mean, I've taken hiatuses on this show before. I'm not going to take a hiatus anytime in the future, but bear markets are not fun for anybody. And that would also affect my entire outlook on geopolitics and politics in general, because a lot of this show is built off this deflationary outlook where Bitcoin is the solution. But if Bitcoin isn't the solution, guys, like relatively soon in the next 4 to say 5 to 10 years, if it's going to take 20 years, that means we're going to be going through this deflationary grind for 20 more years. We're going to go through social upheaval for 20 more years. That's a very depressing state of affairs. And Bitcoin is supposed to be optimistic. It's supposed to be uplifting. Like that's why many gold bugs, and myself included, came from gold to Bitcoin, because gold is very passive, where Bitcoin is very active, going and changing the world. Let's take a look at gold since I talked about that. Big red candle for the day, just like Bitcoin, I guess. But a lot of people are, like I said, Peter Schiff is saying it's on the launch pad. Let's zoom out. Oh, wait, let me go back to Bitcoin. And I need to share this with Telegram. Now we can go to gold. I'm going to zoom out. I don't hate gold. I like gold a lot. I still own gold for the same monetary fundamental reasons that I found Bitcoin, because of the sound money nature, the counterparty free, there's no counterparty risk involved if you hold your own gold, not if you hold it in a vault somewhere. That's the same thing. But like I don't hate gold, but this does not look like a good chart to me. It missed hitting this trend line right here by a very small amount, actually. Only, what is that? About $20. That's not only the trend line, that's not even a new high, because this trend line actually slopes downward. So that is, and the close was not even at the top. So this is a very weak chart in my opinion, and this could crash quite dramatically. I mean, it could go back way down to 18, into the 1800s. I saw Joe Carlaseri. He said he's expecting 1920. That would be touching this 2011 high. I expect it to probably fall lower than that. If it gets to 1920, it's not going to stop. That really hasn't been an important level other than this one time back here in 2021. That was an important level, maybe here, but that wick went through it. So really that old high hasn't been all that important. I don't expect it to continue to, I expect it to continue to not be important. And we do have a lower low here. So we have a lower low, guys. It's could crash down like this. I mean, what would that mean? Oh my God. What would that mean for Bitcoin? I think that would be horrible. That would mean that Bitcoin is crashing as well. Let's take a look at the dollar. I mean, it doesn't have to mean that, but maybe I'm just in a pessimistic mood today, guys. I need some hopium. Where's my hopium? I mean, this is the first green week on the dollar in, what is that? 6 weeks. That's a pretty good sign. We'll see if this can turn around. The dollar does tend to trend pretty hard. You can see that. So if this is a double bottom and a first green week in the last 6 weeks, this could mean that the dollar is set to rally, and that would fit with a liquidity problem, with a dollar crunch or collateral shortage, however you want to call it. The dollar rallying would be fit right in there. Okay, let's take a look at oil. Oh, this is weekly here. It's down pretty hard. Oil is also green on the day, but not by much. Still has a little bit to go until you close that gap. Oops, wrong button. Let's go back to where was I? The dollar. I'm going to share that with Telegram. All right. And lastly, let's take a look at the stock market. I mean, it's looking decent on the weekly, on the daily. It's struggling. It's trying to hold up there. Does I don't see any sort of imminent bear move on this chart like I do necessarily on the dollar chart, or sorry, the gold chart, other than, well, we only had one close, daily close, but not making it to this line does signify some weakness. However, it hasn't dropped. So it doesn't look like this is a momentum filled move to the downside as it does in gold. So let me post that. All right. Well, what I'm going to do is open up the mic and I'm going to leave it open and I'm going to relay what, if anybody has any questions, comments, concerns over there on Telegram, and I'll relay that to the live stream here. This is kind of what I did in the first days of doing these live streams, but we'll see how this goes. So if you guys over there on Telegram have any comments, questions, concerns, any topics you want to bring up, let's do it. All right. Well, if there are no hands, I'm going to wrap it there for today, guys. Thank you for joining me. My name is Ansel Lindner. This is Bitcoin and Markets. A little bit of a downer day. Not a lot of news out there. Some green daily, or sorry, some red daily candles makes for kind of a depressing start of the weekend. But I hope you guys have a great weekend. Get out there with friends and family. It's starting to get warmer pretty much everywhere around the world. So hopefully you can enjoy some time in the sunshine, getting out and getting activity out in the outside. And that's going to do it, guys. So thanks for joining again, and I'll see you on the next one.